Hello, and welcome to another episode of TacoBytes, your Daily Bite of Degen, episode number 379. We're going to be covering two things today, both the grayscale ruling from the lawsuit being overturned by the Appealet Court, and we're also going to be looking at Sedona, something we learned about today. First time look, so we'll see what it looks like. But first off, we wanted to go through the U.S. This was Tuesday. The U.S. court says, and we were going through Reuters for this. Good coverage of it. There's a lot of different good sources on this. I liked Reuters' pieces on it. And then we're going to go to the actual ruling and sort of break down what that means, from my opinion. This U.S. securities regulator was wrong to reject an application from Grayscale Investments to create a spot Bitcoin ETF. Exchange-traded fund. Federal Appeals Court ruled on Tuesday in a landmark victory that could pave the way for the first product of its kind. The three-judge panel of the District of Columbia Court of Appeals in Washington said the Securities and Exchange Commission failed to fully explain its reasoning when denying Grayscale's product and should review its decision. The price of Bitcoin, the world's largest cryptocurrency, was last up more than 6% to 27,858 following the news. Spot Bitcoin ETF would track its underlying market price, giving investors exposure to the digital asset without having to buy the currency. The SEC has denied all proposed Bitcoin ETFs, including Grayscale, saying they do not meet its bar for preventing market manipulation. While the ruling does not mean Grayscale's ETF is automatically approved, it is a big boost for the decade-long industry's effort to advance a Bitcoin ETF product. The court decision is a historic milestone for American investors, Grayscale CEO Michael Sorensen said in a statement. Sorensen, Grayscale spokeswoman, added the company was reviewing the details and would pursue next steps with the SEC. The SEC has 45 days to appeal the ruling. An agency spokesperson said it was reviewing the court's decision in order to determine the next steps. The cryptocurrency industry was quick to hail the ruling. Several other asset managers, including BlackRock, Fidelity, and Invesco, had similar filings pending with the SEC for a spot Bitcoin ETF. This ruling is not just about Grayscale Bitcoin. It sets a precedent for the broader crypto industry, said Gm², general counsel and head of global policy at the Crypto Council for Innovation. The SEC rejected Grayscale's application for a spot Bitcoin ETF in June 2022, arguing the proposal did not meet anti-fraud and investor protection standards. Cited the same reason in its denial of a dozen of other applications for similar products, including ththose from Fidelity and Van Eck. Grayscale sued the SEC, arguing that because the agency previously approved certain surveillance agreements to prevent fraud in Bitcoin futures-based ETFs, the same setup should also be satisfactory for Grayscale's spot fund, since both spot and future funds rely on Bitcoin's price. The court said in its ruling that the SEC failed to explain why it disagreed with Grayscale's assertion that the Bitcoin spot and futures market are 99.9% correlated. The commission's unexplained discounting of the obvious financial and mathematical relationship between the spot and futures markets falls short of the standard for reasoned decision-making, the court said in an opinion, which was filed by Judge Neil Ray of the D.C. Court of Appeals. The ruling is the second major legal victory for the crypto industry in recent weeks, after a judge ruled in July in a case brought by the SEC that Ripple Labs did not violate federal laws by selling its XRP token on public exchanges. The SEC has said it plans to appeal that finding. If the SEC appeals the Grayscale ruling, the case would go either to the U.S. Supreme Court or a review by the entire D.C. Appeals Court. If the SEC chooses not to appeal, the court would issue a mandate specifying how its decision should be executed. That could include instructing the SEC to approve the application or to revisit Grayscale's application, in which case the SEC could still reject the proposal on other grounds. It remains to be seen how the ruling might affect proposals submitted in June by BlackRock, the world's largest asset manager, and several other firms to offer spot Bitcoin ETFs. The SEC has not yet to deliver a decision on those applications. One thing that we have heard, considering all applications, that the SEC has actually put off until October any ruling on those. So we will see if that pushes things back a little bit, and what the rest of the market decides to think on that. One of the things I wanted to go over real quickly today was the actual ruling, so that we can see that together, and so you can sort of see that. I'm going to put that in the chats. And real quickly, I just want to thank everyone from Twitter, YouTube, Telegram, Twitch, and my Unlonely family for joining us today. But here is the full storage piece for the U.S. government courts. We hope that you're able to find some stuff with this that, you know, goes a long ways. And so we want to hope that you can find, that's what we wanted. That you're able to find some reading with this that brings some ideas to you on what you think it means. And I would love to know what your thoughts are in the comments as well. And once again, a huge shout out to Unlonely family. I've been really liking Unlonely on how it's been helping out with just making it really easy to stream and simple, even into Warpcaster. So huge shout out to the Warpcaster family and everyone there. Let's boom. And so on petition for the review of an order of the Securities Exchange Commission decided August 29th, argued March 7th of this year. On the petition, Donald B. Verrilli Jr. argued the case for a petitioner. With him on the briefs were Paul Mayskin, Joseph Hall, Daniel Schwartz, Elaine Goldenberg, and Sarah Weiner. Jonathan Cooper, Rachel Frank were on the brief for the amicus brief from the Blockchain Association. Joseph Palmore were on the amicus brief from Coinbase as well in support of the petitioner. Robert Long and Kevin King were on the brief from New York Stock Exchange ARCA in support of the petitioner. Another amicus from brief in support of the petitioner. Oh man, let's see here. 1, 2, 3, 4, 5. 5 different amicus briefs were filed on behalf of the petitioner. Emily Truprey, senior Appealet Court, Securities Exchange Commission, argued the cause for a respondent. With her on the brief were Megan Barbero, Michael Conley, Tracy Harden, David Litzler, and Daniel Young. Before Chief Judge Rao, Circuit Judge, and so Servanson, Rao, words. So it is a fundamental principle of the administrative law that agencies must treat like cases alike. The Securities and Exchange Commission recently approved the trading of 2 Bitcoin future funds on national exchanges, but denied approval of Grayscale's Bitcoin fund. Petitioning for review of the Commission's denial order, Grayscale maintains its proposed Bitcoin exchange-traded product is materially similar to Bitcoin futures exchange-traded products, should have been approved to trade on the New York Stock Exchange ARCA. We agree. The denial of Grayscale's proposal was arbitrary and capricious because the Commission failed to explain its different treatment of similar products. We therefore grant Grayscale's petition and vacate the order. Before listing a new product for trading, a securities exchange generally must file a rule change with the SEC. The Commission shall approve a new rule if it finds that such proposed rule change is consistent with the requirements of the exchange. Under the Exchange Act, the rules of an exchange must be designed to prevent fraudulent and manipulative acts and practices, to promote just and equitable principles of trade, to foster cooperation and coordination, to remove impediments to a free and open market, and in general to protect investors in the public interest. The rules of the exchange may not be designed to permit unfair discrimination between customers, issuers, brokers, or dealers, or to regulate matters not related to the administration of the exchange. The Commission has not promulgated a regulation interpreting interpreting and implementing these standards. Rather, it approves rule changes on a case-by-case basis. The burden to demonstrate that a proposed rule change is consistent with the Exchange Act is on the securities exchange proposing the new rule. This case involves two kinds of exchange-traded products, those holding Bitcoins and those holding Bitcoin futures. Grayscale's primary claim is that the commission failed to treat like cases alike by denying the listing of Grayscale's proposed Bitcoin ETP and approving two Bitcoin futures ETPs. Because assessing these claims requires an understanding of how the product work, we briefly explain Bitcoin, the spot and futures market, and exchange-traded products. Bitcoins are cryptocurrency, kind of digital token that can be used to pay for goods and services directly or exchange for traditional currencies. Bitcoin is not tracked through bank ledgers like traditional currencies. Instead, Bitcoin transactions are recorded on a blockchain maintained by a decentralized computer network. One Bitcoin was worth less than a penny in 2009, and by mid-2023 was worth more than 30,000. As with commodities, there are spot and future markets for Bitcoin. A spot market is another term for the cash market of a commodity or financial instrument. In the Bitcoin spot market, cash is exchanged for Bitcoin with delivery expected immediately. In a derivatives market, by contrast, the financial instrument being traded derives its value from the underlying spot market, but it is not traded on that market. One such derivatives is a future, which is a contract to buy or sell an asset at a predetermined price on a specific later date. Future contracts, which enable investors to hedge against risk, trade on commodity futures exchanges like the Chicago Mercantile Exchange, the CME. A global derivatives market, the CME, is regulated by the CFTC. At issue in this case are Bitcoin investment funds that hold either Bitcoin or Bitcoin future contracts. Many Bitcoin and Bitcoin future funds have sought to be listed and traded on a national exchange, that is, to become exchange-traded products. An exchange-traded product may offer continuous share redemption and creation, allowing arbitrage to prevent the product's price from deviating too far from the value of its underlying asset. Products not traded on an exchange cannot offer this, so rather than tracking the value of underlying assets, they often trade at a discount. Listing on an exchange is desirable because it helps eliminate this discount. Over the last several years, the Commission received numerous proposals to list Bitcoin investment products on national exchanges. The Commission denied every proposal to list a Bitcoin ETP. For example, in 2018, the SEC denied BAT's BZX exchange proposal to list the Winklevoss's Bitcoin Trust, Winklevoss Order. And in 2020, the SEC denied New York Stock Exchange ARCA proposal to list the United States Bitcoin and Treasury Investment Trust, USBTTT. In each of these orders, the SEC denied the listing of the proposed Bitcoin ETP for the same reason. The products were not designed to prevent fraudulent and manipulative acts and practices as required by the Exchange Act. Specifically, the SEC found that protections inherent in Bitcoin, like the blockchain and the size and liquidity of the Bitcoin market, were insufficient to prevent fraud. The Commission instead required a surveillance sharing agreement with a related and regulated market of significant size. But every proposed Bitcoin ETP failed the Commission's significant market test. Two Bitcoin future ETPs, however, were recently approved by the Commission. In April 2022, the Commission approved New York Stock Exchange ARCA's proposal to list the Triconium Bitcoin Futures Fund. A month later, the NASDAQ proposal to list the Valkyrie XBTO Bitcoin Futures Fund was approved. Valkyrie order for both products, the listing exchange had a surveillance sharing agreement with the CME and that the Commission found satisfied the significant market test. In both orders, the Commission explicitly stated that approval of Bitcoin futures ETPs did not mean approval of Bitcoin ETPs was imminent. The Grayscale Bitcoin Trust is a would-be Bitcoin ETP. Grayscale currently owns 3.4% of outstanding Bitcoins worth tens of billions of dollars. Grayscale's order, if Grayscale traded on exchange, it would be worth roughly the value of the assets in the trust. Because Grayscale does not have SEC approval to trade on an exchange, however, its shares are restricted securities with trading limited to accredited investors and over-the-counter markets not registered with the SEC. As Grayscale explains, it cannot offer the continuous share redemptions and creations that are permissible for ETPs and add enormous value. Accordingly, Grayscale shares trade at a discount, as much as 30%. Grayscale estimates this leaves over $4 billion on the table for its investors. And the New York Stock Exchange, ARCA, an affiliate of the New York Stock Exchange, proposed listing shares of the Grayscale Bitcoin Trust. Of the thousands of public comments, nearly all favored listings Grayscale. Nonetheless, the commission denied the rule change, finding the New York Stock Exchange ARCA had not met its burden to demonstrate its proposal was consistent with the requirements of the Exchange Act. As with every other proposed Bitcoin ETP, the commission found Grayscale was not designed to prevent fraudulent and manipulative acts and practices and failed to satisfy the significant market test. We have jurisdiction over Grayscale's petition under the Exchange Act, which provides that a person aggrieved by a final order of the commission may obtain review of the order in the United States Court of Appeals for the District of Columbia Circuit in filing such court within 60 days. The Administrative Procedure Act requires that reviewing a court to hold unlawful and set-aside agency action that is arbitrary, capricious, an abuse of discretion, or otherwise not in accordance with law. While assessing an arbitrary and capricious claim, we consider whether the agency's decision was reasonable and reasonably explained. We will not substitute our policy judgments for that of the agency. Instead, we ensure the agency considered all the relevant issues and adequately explained the decision. In these two parts, what the judges are basically saying is they lay out, one, the reason the Securities Exchange Commission denied Grayscale's Bitcoin ETP, which was there wasn't enough fraud manipulation overview. And then what Grayscale counter-argued was that two different ETPs have been approved that met this burden of fraudulent oversight that the SEC said was needed, so that they could be traded under the CFTC. And so the Securities Exchange Commission denied this with no reasoning or not sufficient reasoning. And so the courts are now stating in their order that these are the things that were approved by the SEC. These things met the SEC's test. This, being the Grayscale BTC ETF, does meet these requirements that the SEC set forth. And so the SEC cannot use that same argument to further deny it. And so we'll get back into this real quick. Grayscale's primary argument is straightforward. The commission acted arbitrarily and capriciously by denying the listing of Grayscale's proposed Bitcoin ETP and approving the listing of materially similar Bitcoin future ETPs. To evaluate Grayscale's petition, we first must consider whether Grayscale demonstrated its investment product was similar across the relevant regulatory factors to the Tellurium and Valkyrie ETPs that were approved by the commission. The great principle that like cases must receive like treatment is black letter administrative law. So what they're saying here is that when the SEC treats a company one way, it must treat all other companies the same, and that this is the standard law. And this is true. We have seen this time and time again. The SEC has been getting the backhand of a lot of actions to where they try to say regulation meets one standard, but it doesn't meet another standard for another company that is doing the same exact thing. And so in this case, we now have an Appealet Court that states that the Grayscale must have its fair day, or if the SEC doesn't appeal this within 60 days, the court can do two things: force the SEC to approve Grayscale's ETP application, or send it back to the SEC for full review. And as we know, we know that is now what the SEC is doing. A fundamental norm, in fact, is similar treatment of evidently identical cases is the quintessence of arbitrariness and caprice. Failing to distinguish prior orders in similar cases fails to satisfy the APA's reasoned decision-making requirement, particularly when agencies articulate legal standards on a case-by-case basis. They must justify different results reached on similar facts to lend predictability and intelligibility to agency actions that promote fair treatment and facilitate judicial review. These principles are especially salient here, as the Commission must ensure the rules of an exchange are not designed to permit unfair discrimination between customers, issuers, brokers, or dealers. Treating similarly situated parties differently is at the core of unfair discrimination. If we find that Grayscale is similar to the Bitcoin futures ETPs across the relevant regulatory factors, we must determine whether the Commission provided an adequate explanation for approving the two Bitcoin futures ETPs but denying Grayscale's Bitcoin ETP. If a partly plausibility alleges it has received inconsistent treatment under the same rule or standard, we must consider whether the agency has offered a reasonable and coherent explanation for the seemingly inconsistent results. Grayscale advanced substantial evidence that its proposed Bitcoin ETP was similar to the Takarium and Valkyrie Bitcoin futures ETP, and therefore should have received the same regulatory treatment. Grayscale's proposed Bitcoin ETP and the approved Bitcoin futures ETP all track the Bitcoin market price, i.e. the spot market price. Grayscale's link is direct. It holds Bitcoin. Grayscale calculates the value of its Bitcoin assets using the CoinDesk Bitcoin Price Index, which is based on spot trading across 4 major Bitcoin platforms. The Bitcoin futures ETP holds CME futures contracts, but their exposure to the spot market price is nearly identical to Grayscale's proposed ETP. Grayscale presented uncontested evidence that there is a 99.9% correlation between Bitcoin spot market and CME futures contract prices. This tight correlation is not a coincidence. Bitcoin future prices are ultimately based on spot market prices. Bitcoin futures trade based on predicted sentiment prices that are in turn calculated using the Bitcoin reference rate. The reference rate, like the CoinDesk index, aggregates spot prices from multiple exchanges. 4 of the 6 exchanges are shared between the indexes. The study conducted by a finance professor and expert on derivatives contract valuation found the CoinDesk index and the reference rate are near perfect substitutes. Moreover, the listing exchanges for Grayscale and the Bitcoin futures ETPs have identical surveillance sharing agreements with the CME. All right, so let me back that up for just a second and explain what the last structure was before we move on to this, because this is now we're going to be talking about the surveillance sharing agreements, which is the fraud prevention pieces. What the SEC was saying was market manipulation. How did market manipulation was going to come about was through price fluctuations. Currently, the differences between exchange and closed securities, only sell to approved investors, is that they have to sell at a discount, where on futures they sell at price spot. And so where they feel that there will be less market manipulation through this platform, and what they're actually saying is that investors will benefit more because there's so much money lost on the table because things are being sold at a discount at OTC, over the counter. So where Grayscale is using the CoinDesk Bitcoin Price Index, the CoinDesk, Bitcoin Price Index aggregates, I think I read at one time 20 different sources, files it down to, but it has 4 sort of validators in price, and then it gives you that running price there. I think it's like the lowest price out of those 4 sort of has the heavier weight, if I remember right on that equation. But the reason why it does that is so that it can follow market movements better. And by always sticking with one, you always follow the same rules. You'll, even if those rules are slightly off, they're always slightly off. And so that would give a better price history than having, multiple different price points. And so it's been set as a really good piece. Now, as we can see here, remember there was 5 amicus briefs filed on behalf of not only Grayscale, but 5 other petitioners that filed briefs with the courts on behalf of Grayscale, saying the SEC was wrong in this. And so one of those pieces was a study that was actually conducted, was submitted as evidence, citing CoinDesk's Bitcoin index being near perfect for the entire market. So if you always want to get a good price on Bitcoin, check out CoinDesk. Moreover, the listing exchanges for Grayscale and the Bitcoin futures ETP have identical surveillance sharing agreements with the CME on which Bitcoin futures trade. Because the spot and future markets for Bitcoin are highly related, it stands to reason that manipulation of either market will affect the price of Bitcoin futures. The Commission acknowledges this connection when approving the TacoBytes and Valkyrie ETPs. The Commission found CME surveillance can reasonably be relied upon to capture the effects on the CME Bitcoin futures market caused by a person attempting to manipulate the proposed futures ETP. Whether that attempt is made by directly trading on the CME Bitcoin futures market or indirectly by trading outside of the CME Bitcoin futures market. To the extent that the price of Bitcoin futures might be affected by trading in both the futures and spot markets, the Commission concluded fraud in either market could be detected by surveillance of the CME futures market. So the big argument by the SEC was that surveillance and fraud couldn't be detected. Well, this is the Chicago Mercantile Exchange basically stating that, yes, it can be. Grayscale has demonstrated its proposed Bitcoin ETP is materially similar across relevant regulatory factors to the approved Bitcoin futures ETPs. First, the underlying assets, Bitcoin and Bitcoin futures, are closely correlated. And second, the surveillance sharing agreements with the CME are identical and should have the same likelihood of detecting fraudulent or manipulative conduct in the market for Bitcoin and Bitcoin futures. Despite these salient similarities, the Commission rejected Grayscale's proposed Bitcoin ETP and approved 2 Bitcoin futures ETPs. The Commission distinguished the 2 products solely through the application of the significant market test. The Commission requires Bitcoin-based ETPs to address concerns of fraud and manipulation by having their listing exchanges enter into surveillance sharing agreements with markets that are 1, related to the listing exchange, and 2, regulated, and 3, of significant size. If fraud or manipulation occurs, the surveillance sharing agreement, in theory, should identify the problem. Surveillance sharing agreements provide a necessary deterrent to manipulation because they facilitate the availability of information needed to fully investigate a manipulation if it were to occur. The Commission acknowledges the New York Stock Exchange ARCA has a surveillance sharing agreement with the CME. The CME Bitcoin futures market is related to Grayscale's proposed ETP, and the CME is adequately regulated by the CFTC. The only dispute is whether the CME market for Bitcoin futures is a market of significant size. Despite its name, the significant market or market of significant size requirement implicates more than the size of the surveilled market. To allow the Commission to assess whether market manipulation will be detected in the surveillance market, the significant market test has 2 prongs. First, there must be a reasonable likelihood that a person attempting to manipulate the ETP would have a trade on a related market to successfully manipulate the ETP. In other words, the Commission will consider whether a person attempting to manipulate the ETP could simply bypass the regulated market and thus circumvent the surveillance. Second, it must be unlikely that trading in the ETP would be the predominant influence on prices in the surveilled market. If trading on the ETP dominated prices in the surveillance market, that market might be unable to pick up price discrepancies between the ETP and its underlying assets. The Commission concluded that Grayscale, like every other proposed Bitcoin ETP, failed to meet both prongs of the significant market test. By contrast, the Commission found the significant market test satisfied for the Valkyrie and TacoBytes Bitcoin futures ETP. This differential application of significant market requirement is at the core of Grayscale's arbitrary and capricious challenge. We take each prong in turn. So one of the big pieces here where the SEC further on the alleged fraud manipulation Overwatch, it said that these two companies, Tacarium and Valkyrie, were able to meet those needs, but because they are futures, and so they're under the CFTC. The Securities Exchange Commission is trying to keep the Grayscale ETF under its control rather than allowing it to fall under the CTCF. And so we're seeing a little bit of a battle between the CTFC, and the SEC. Once again, this is something that's gone on for a long time, so this isn't something new. This is, I apologize my rude language, this is just a pissing contest at times, and companies fall in the middle of the crosshairs, and this is what happens. The commission found the Grayscale failed the first prong of the significant market requirement because there was not a reasonable likelihood that a person attempting to manipulate would have to trade on the CME. On the other hand, the commission found it was unnecessary for the Bitcoin futures ETPs to establish a would-be manipulator would have to trade on the CME. On whether a reasonable likelihood that would-be manipulator of the proposed ETP would have to trade on the CME did not prevent approval. According to the commission, this showing was unnecessary for the Bitcoin futures ETP because their only holdings are securities traded directly on the surveilled exchange. Grayscale maintains it should be treated the same as the Bitcoin futures ETP, despite the fact that its holdings do not trade on the CME. Grayscale has the same economic risks as the futures ETP, and so a surveillance sharing agreement with the CME should have similar fraud prevention capabilities. Therefore, Grayscale reasons it should be exempted from the first prong. Under the first prong of the significant market test, the commission failed to provide necessary, reasonable, and coherent explanation for its inconsistent treatment of similar products. So this is the Appealet Court's ruling that it says under the first prong of the market test, the Securities Exchange Commission failed to hold its point of view that this was the grounds for denying Grayscale's Bitcoin ETF. The commission never explained why Grayscale owning Bitcoins rather than Bitcoin futures affected the CME's ability to detect fraud. While the commission asserted that owning assets not traded on the surveilled exchange was a significant difference and proclaimed that there was reason to question whether a surveillance sharing agreement with the CME would in effect assist in detecting and deterring fraudulent manipulative misconduct affecting the price of the spot Bitcoin held by that ETP, it provided no support for these claims. Grayscale, however, provided evidence that the CME Bitcoin futures price are 99.9% correlated with spot market prices. Based on that data, fraud in the spot market would present identical problems for a Bitcoin ETP and a Bitcoin futures ETP. Bitcoin futures are derivatives of Bitcoin, and as long as the market is efficient, arbitrage will drive the prices together. The commission neither disputed Grayscale's evidence that the spot and futures market for Bitcoin are 99.9% correlated, nor suggested that market inefficiencies or other factors would undermine the correlation. Let's see here. The commission faults Grayscale for failing to provide other types of evidence. Hold on one second. There we go. Without further explanation, however, the commission's assertion that information for this filing does not support the claim that any fraud or manipulation in the underlying spot market will affect both products in the same way is unreasonable. The commission's unexplained discounting of the obvious financial and mathematical relationship between the spot and futures market falls short of the standard for reasoning decision-making. It would be presumably arbitrary and capricious to ignore the obvious. Even if the spot and futures markets are highly correlated and respective ETPs are functionally identical, the commission maintained Grayscale would not pass the first prong of the significant market test. Why? The commission claimed correlation analysis does not provide evidence of the causal economic relationship of interest, namely whether fraud or manipulation that impacts spot Bitcoin would also similarly impact CME Bitcoin futures contract. So what they're arguing here is that if there is fraud on one price of Bitcoin, that it won't necessarily mean fraud on the other. And so they're saying one Bitcoin type of instrument is fraud-free, while another Bitcoin instrument is able to be manipulated. That is the SEC standing for this case. When approving the Bitcoin futures ETPs, the commission acknowledged the risk of fraud to Bitcoin futures from trading outside of the CME Bitcoin futures market, such as trading in the spot market. This was an important problem to address for the future ETPs because future markets are hard to manipulate because of actual and potential competition from the cash commodity. So the primary risk is often in the spot market. Fraud and manipulation in the Bitcoin spot market pose a similar risk to both futures and spot products. Because the spot Bitcoin market and the CME Bitcoin futures market are so tightly correlated, a price distortion in the spots market will be reflected in the price of the futures market. After all, futures are derivatives of the spot market. The SEC did not suggest that a 99% correlation was coincidence or caused by some third variable. We recognize the basic principle that mere correlation does not equal causation, but here the correlation was based on the logical and mathematical connection between the spot and futures market. In this context, the almost perfect correlation was at least strong evidence of causation, and the commission failed to explain why a surveillance sharing agreement with the CME was sufficient to protect Bitcoin futures from potential fraud, but not Grayscale's proposed Bitcoin ETP. The commission also faulted the New York Stock Exchange ARCA for failing to demonstrate the futures market leads the spot market. Because evidence of the lead-lag relationship between the two markets was inconclusive, the commission doubted the connection between the two markets. Whatever the reality of the lead-lag relationship, however, by requiring this evidence from Grayscale, the commission failed to treat like cases alike. When approving the Bitcoin futures ETPs, the commission found evidence of a lead-lag relationship to be unnecessary. Yet when rejecting Grayscale's Bitcoin ETP, the commission said it considered the lead-lag relationship to be central to understanding whether it's reasonably likely that a would-be manipulator of the spot Bitcoin ETP would need to trade on the futures market. The commission offered no compelling reason why the lead-lag relationship between spot and future Bitcoin markets was central for assessing the potential for fraud and manipulation of Bitcoin ETPs, and yet unnecessary for assessing Bitcoin future ETPs. When denying Grayscale under the first prong of the significant market test, the commission failed to reasonably explain why it approved the listings of two Bitcoin futures ETPs, but not Grayscale's similar proposed Bitcoin ETP. Without such an explanation, inconsistent treatment of similar products is arbitrary and capricious. So what the court is saying here is, just like the court said earlier, futures are derivatives of an original asset. If there's enough overview to keep the derivatives safe, there should be enough safety in place to keep the original safe as well. This is the funny thing here. It's not actually saying stop market manipulation. It's saying able to see it and during an investigation and follow it. And so it's rather an interesting piece there that, it seems like preventative Band-Aids and just don't type of oversight. The commission also applied the second prong of the market test unreasonably. The commission concluded there was a risk that trading Grayscale would be a predominant influence on prices in the CME Bitcoin futures market, and therefore Grayscale could not meet the second prong of the significant market test. We conclude the commission's reasons for differentiating Grayscale from the Bitcoin futures ETPs again fall short. First, the commission failed to explain how the proposed Grayscale Bitcoin ETP would be the predominant influence on the price of Bitcoin futures traded on the CME. The commission's primary argument appears to be that because Grayscale has substantial assets valued at approximately $30 billion with potential for further growth, Grayscale might dwarf the CME market for Bitcoin futures, which had approximately 1.7 billion of open contracts. The commission also expressed concern about the relative trading volume between Grayscale and the CME Bitcoin futures market. According to the commission, Grayscale provided no explanation for why a single Bitcoin ETP with trading volume close to 1/4 of the CME Bitcoin futures market was not likely to be the predominant influence on prices in the market. The commission, however, did not adequately connect the value of Grayscale's assets to the conclusion that those assets would influence prices in the CME futures market. Because Grayscale owns no futures contracts, trading in Grayscale can affect the futures market only through the spot market. The only way in which the trust could conceivably be predominant influence on prices in the market is by virtue of its effect on prices in the Bitcoin spot market. But Grayscale holds just 3.4% of outstanding Bitcoin, and the commission did not suggest Grayscale can dominate the price of Bitcoin. In light of these economic realities, the commission should have explained why it considered the relevant comparison to be the value of Grayscale's assets as a percentage of the total value of the CME Bitcoin futures market. Simply faulting New York Stock Exchange ARCA for not directly addressing this ratio was neither reasonable nor reasonably explained. An agency may ask a regulated party for further information, but such requests must be reasonably related to the relevant regulatory standards. The commission also expressed concern that Grayscale underestimated the potential for growth if I lost my spot. The commission also expressed concern that Grayscale underestimates its potential for growth if approved as an ETP, and that if such growth occurred, the ETP could overwhelm the futures market. Grayscale, yet the commission did not adequately justify this concern in light of the record before it. As the commission acknowledged, Grayscale owns only 3.4% of outstanding Bitcoin at 40,314, and Bitcoin is a deep and liquid market. One comment included evidence that Bitcoin had an average daily trading volume of approximately 45 billion, which is significantly higher than that of the largest equity stocks. At 40, this is the kind of evidence the commission has repeatedly relied on to approve other ETPs. Approving a gold ETP in part because the spot markets were extremely deep and liquid. The commission did not explain why Grayscale underestimating the growth potential of its spot asset posed a threat to the CME's Bitcoin future market, which is the market under surveillance. Moreover, the commission dismissed evidence that could have mitigated concerns about Grayscale growing to have the predominant influence on Bitcoin prices. Because future inflows cannot be predicted, New York Stock Exchange ARCA compared the historical inflows of Bitcoins into Grayscale to Bitcoin's market capitalization. Grayscale the comparison showed that while Grayscale experienced nearly 7 billion of inflows over a 2-year period, the market capitalization of Bitcoin grew by 721 billion during the same time period. This evidence suggested Grayscale was unlikely to dominate price because the spot Bitcoin market was huge and growing faster than Grayscale. In addition, the record included evidence that among global commodity ETPs, Grayscale would rank 4th in assets under management and 7th in trading volume, so its size was not unusually large. By presenting this evidence, Grayscale and the New York Stock Exchange ARCA sought to demonstrate that Grayscale's ETP would have a minimal impact on the Bitcoin spot price because of its relatively small share of the large and fast-growing Bitcoin market. Grayscale's evidence directly addressed the commission's concerns. If trading in Grayscale has a minimal impact on the price of Bitcoin, it necessarily follows that trading in Grayscale will have a minimal impact on Bitcoin futures. If the commission thought these economic realities do not hold true for the Bitcoin market, such that trading in Grayscale would be the predominant influence on the CME futures market, it failed to sufficiently explain this conclusion in light of the record. The commission also failed to treat like cases alike under the second prong of the significant market test with respect to Bitcoin futures ETP. The commission found the second prong was satisfied because the CME Bitcoin futures market had progressed and matured significantly. So trading on a single ETP was unlikely to be the predominant influence on the CME. The Takarium and Valkyrie Bitcoin futures ETPs hold assets that trade on the CME, namely the Bitcoin futures contracts. When explaining why trading in these ETPs would not predominantly influence prices in the CME futures market, the commission focused on the robustness of the market. The commission emphasized the size and liquidity of the CME futures market, finding that nearly every measurable metric related to Bitcoin futures had trended consistently up. Trading in Bitcoin futures increased from 737 million in December 2017 to 44.6 billion in December 2021. As the commission concluded, the CME was a large futures market, and so there was little reason to think trading of a single ETP would be the predominant influence on prices in that market. The commission failed to explain why this reasoning does not similarly apply to Grayscale. The New York Stock Exchange ARCA had the same surveillance sharing agreement with the CME, and the CME Bitcoin futures market is robust as the commission recognized in its previous orders. Because the spot market is deeper and more liquid than the futures market, manipulation should be more difficult, not less. The commission's reason for approving the Tacarium and Valkyrie ETPs seemed to apply equally to Grayscale, but Grayscale's listing was denied. Lacking a reasonable and coherent explanation for these seemingly inconsistent results, the commission's order in this case is arbitrary and capricious. To avoid arbitrariness and caprice, administrative adjudication must be consistent and predictable, following the base. So this is the final statement by the courts. What we're going to go over real quick is just sort of what they've stated before we get to this final paragraph. So what they've sort of covered so far is the fact that, Grayscale was saying that there was both market depth and liquidity on Bitcoin, that they couldn't control the market. The Securities Exchange Commission was trying to first tell one company that it approved that there's enough depth and liquidity that the market can't be manipulated, and then did that actually with two companies, and then when it came to Grayscale said that they had too much at 3.4%. And so we saw that being one of the major influences that used on that second prong why the SEC attempted to deny Grayscale's Bitcoin ETP. But then with the courts overturning that, what they stated is that the SEC said that there was enough depth and liquidity, that the prices between futures and spot are correlated enough that, if a derivatives can survive and thrive, then the parent asset of that can as well. And so they basically are agreeing that the SEC's ruling is capricious. So to avoid arbitrariness and caprice, administrative adjudication must be consistent and predictable, following the basic principle that similar cases should be treated similarly. The New York Stock Exchange ARCA presented substantial evidence that Grayscale is similar across the relevant regulatory factors to Bitcoin futures ETPs. The commission failed to adequately explain why it approved the listing of two Bitcoin futures ETPs, but not Grayscale's proposed Bitcoin ETP. In absence of a coherent explanation, this unlikely regulatory treatment of like products is unlawful. We therefore grant Grayscale's petition for review and vacate the commission's order. So what does that mean, and what is that doing for everyone right now? So one, it's basically sending everyone back to the drawing board. What we've now seen is the SEC has gone back and said that all the ETFs that are out there, there's 6 pending right now, are on hold until October. And the reason why is because they're playing their game. So what we thought would happen in this month, won't. We'll see what happens next month. And as the SEC attempts to either approve these market trends that are happening, as more and more companies are attempting to put in ETFs and bring crypto assets to the market, mainstream market, we'll see how that goes. What does that mean for Bitcoin as a whole? It will mean that the price is owned and underlying asset is owned by more people, but not the asset itself. Sort of like gold before the dollar was taken off the gold as a promissory note. Oh my gosh, what is that term? Backed by gold. I forget it. But a piece of paper that represents a Bitcoin or something like that. And so what we really hope this will do is this will turn more people onto Bitcoin, owning the asset itself. And that doesn't stop this. It doesn't call the Bitcoin a security. It is talking about it. So it's talking about it as an ETF. Excuse me. And so we'll see a lot of different market movement pieces happen on that, which I'm really excited about. And we're going to see a lot more news about this after the second part of this month. There's two major conferences where a lot of think tanks are going to be happening that are going to be talking about this. We have Permissionless coming up in Austin. We have Breathe happening in Vegas, and then Masari Mainnet and ETH Global in New York. And so there's going to be a lot of big minds talking together that normally don't talk together in the same room, and that will bring a lot of great thoughts about this. And so it's going to be really interesting on the regulation side, and can't wait for Permissionless to see that. If you guys have any questions about any of this, please feel free to let me know. Hope to get them answered for you, and hope to have a conversation with some people in the next couple of days that have a lot of experience in this. They've worked for the SEC as an attorney, and we'll start to see if we can get some stuff going there, and talk more about what this regulation piece means. On its face, this is a victory for Grayscale, and as a dick move, the SEC can just, give another reason why to deny it. And then, yes, Grayscale does the same thing, brings it back to court. But we saw 5 amicus briefs that were filed on behalf of this, on behalf of Grayscale. So there is a lot of public support at a legal level that firms are willing to stick their name to this and their reputation. So a lot of good movement is out there, and we hope that you found this enjoyable. As always, we want to end every episode with our words of wisdom and the best worst knock joke on the face of the planet. We want to shout out to everyone on Unlonely, over there at Xenon, YouTube, Twitter, Telegram, Discord, LinkedIn. And for those on Twitter, huge shout out to all my family there as well. So as always, we end with our words of wisdom and the best worst knock joke on the face of the planet. And that is, a closed mouth cannot be fed, and you cannot feed a closed mouth. Meaning, if no one knows you're looking for opportunity can never come a knocking. And if opportunity does come a knocking and no one answers, it's going to keep on walking. And lastly, the greatest, worst knock joke on the face of the night. We hope that you hear a better joke tonight other than this. But knock, who's there?